Insurance Operations section of CFO100. In this lecture, you can learn knowledge about insurance. When you are doing a business, you are always faced with many risks. In general, insurance seems to be out of CFO's coverage, but you need to know the knowledge and you are sometimes involved in this issue. Because this is directly related to risk management and mitigation of critical financial damage. Firstly, you need to remember how your business is surrounded by risks by using simple example. When it comes to that, we are doing simple trade business. We can imagine what types of risks there are. In business contract, you take some parts of risk. Your counterpart also takes the other part of the risk. Seller and the buyers take each risk. Seller often takes responsibility for quality of goods, shipment failure, and delay of delivery. Buyer takes the other kind of risk. For example, price fluctuation, over and short of stock. You may be faced with a surprising incident like that good is stolen by someone. We can imagine those risks, and some of them can be well mitigated and controlled. And the damage is also limited and acceptable level. However, we cannot cover all risks. Some of the risks are difficult to imagine and others are difficult to be compensated. On the seller side, the ship may be attacked by pirates. Government authority may close a port or ban the shipment due to some policy. On the buyer side, a warehouse may catch fire. Insect or something makes its stock bad. Even if you are faced with those accidents, you should mitigate the impact and survive. Why? Because business always have vendors and customers, lenders, and other stakeholders. It means that there are many obligations. If you stop the business caused by accident, it means that you stop the business flow and breach these obligations. If you are operating a power plant, the trouble makes a big effect on tremendous people. The claim amount is huge. Insurance is one of the risk and cost control functions. This is why CFO need to understand the mechanics of insurance and it is uncovered its function. To mitigate uncovered, uncontrollable, critical risks, you should utilize insurance. To understand what kind of insurance you can utilize, you can start from understanding nature of 4 categories of insurance. Left side box group are very traditional insurance many people know. On the contrary, right side box groups are not known by all. However, the size of impact are relatively huge and critical. For trading a business, there are mainly 2 small categories of insurance. First type is an insurance for emergency situation. As it is introduced in the previous slide, in the flow of trading business, there are many kinds of risks, but some of them are accidentally happen, whichever you make effort to avoid it. Pirates and natural disaster risk are those categories. There is another type of risk, which belongs to each counterparty of trading. It is credibility risk. Typical case is that the payment is not done due to a financial reason of customers. Second type of insurance is related to HR issues. One of them is well known by even people who are not engaged in business. To comply with the rule of each country, company needs to pay some parts of social insurance for its employees. The benefit is not coming to company directly, but it reduced the payment for illness. It indirectly reduces the human resource cost. Director responsibility insurance is not known well, but it is important to protect your directors against lawsuits. When you assign employees as director of group company, you have situation to use this insurance. A third category you can see right above box. There is insurance related to facility accident. It mainly consists of three parts: property damage insurance and business continuity insurance are two of them. Environmental insurance has a little bit different taste, but it is included in this category. The detail of property damage and business continuity insurance will be explained in next slide, because these insurances are very important to continue your business and comply with some obligation against stakeholders. Environmental insurance is minor one, but importance of it is increasing more and more in these days. The last category is very special thing related to M&A deal, so I will skip it in this lecture. As an overall picture, CFO should more focus on right side box with some reasons. First, trading insurance and HR insurance can be covered by commercial team and HR division. The mechanics and insurance policy are relatively simple. Those people also understand it and they can take care of it by themselves, even without professional knowledge of risk management, finance, and accounting. Second, the right side box ones are related to whole picture of operation of the business. It is sometimes related to loan and bond obligation. Amount is also large. If you miss the arrangement, it means large amount of cost. Many people are not familiar with the process to obtain it neither. As you have learned the previous slide, CFO need to understand and focus on some kinds of insurance having a large impact to the operation and cash flow. This slide elaborates more about property damage and business continuity insurance. First of all, you should understand why these insurances are important for operation and cash flow. For example, you are running a factory producing some products. By running this factory and selling the products, you are generating cash inflow. In case of an accident happens and the factory has stopped, you cannot produce the products anymore. Your customers complain about it because they expected the product from your factory. Not only the customer, but also you have different obligation to other stakeholders. Those are your shareholders and lenders. Generally speaking, the business having a fixed facility borrows money from banks or issue corporate bonds to cover the long-term fund. Based on loan agreement or a bond indenture, you have to pay back principal and interest. Without operating cash inflow, you cannot comply with the requirement. It causes event of default. Shareholder also requires dividend. It is true that dividend is always paid by excess cash, but shareholders sometimes require stable dividend as we originally planned. As CFO, you need to mitigate those situations by preparing appropriate insurance to cover those risks. Property damage insurance is to cover the cost to fix the facilities. It is quite simple. The point is that there is usually a maximum limit of payment and deductible. Too much large damage is not recovered by this insurance, and too much small damage is not recovered neither. Business continuity insurance is also one of the products to mitigate the impact of risk scenario. During stopping your business, you cannot receive operating cash inflow. Property damage insurance just covers the cost to fix the assets. This is not to cover the less cash in. On the other hand, business continuity insurance gives the company the portion which is not received due to that accident. To continue to comply with some obligation, this type of insurance should be considered. Insurance cost depends on market and respective business. It is regarded as one of the OPEX of business. If the expected impact of damage is large or frequency of event is much, the insurance cost becomes also large. Reducing the insurance cost by negotiation with insurance company and explanation of business to underwriters are one of the important role of CFO. If the size of insurance is very big, companies sometimes hold sessions to explain business situation and overview to those underwriters directly by themselves. That is why insurance issue is one of the important items which CFO should be engaged. Regarding the other category of insurance and how to specifically arrange those will be explained in another session. In this session, you have learned overview of insurance and created a menu list in your mind.